Good morning, everybody. Welcome to today's 1Million by 1Million Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first and only global virtual accelerator for startups. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. Now, this does not mean we're talking about funding 1 million entrepreneurs. A vast majority of the entrepreneurs in the world are not operating in a model that is suitable to venture capital. They need to bootstrap their businesses. However, we do have a huge community of entrepreneurs who are in the market for funding, which is why we do cover funding quite a lot, and we will today as well. This is our 372nd free mentoring roundtable. These have been going on since the fall of 2008, so a very long time. We work with numerous entrepreneurs in all different corners of the world, and it's been absolutely fascinating. The event is being recorded. You will find recordings of all prior roundtables on our YouTube channel, which is 1M1M Roundtables. And if you're live tweeting the show today, please use hashtag 1M1M. Our Twitter handles are at 1Mby1M and at Stromana, and you're welcome to follow any of those. These are channels through which we push an incredible amount of very interesting, educational, inspirational content. Now, this is a roundtable, not a broadcast session. So we would like to hear from you. We want you to participate as much as possible. So these are the call-in numbers for you to call in. You can also use the public chat. Make sure you set your chat to send to all participants, and you can participate in the call. We're not quite ready for call-ins yet, so don't yet start calling in. We will give you the signal of when we are ready for that. We're going to start today's session with a conversation with Mark Achler from Math Ventures, and we are going to get to know both Mark as well as Math Ventures. Welcome, Mark. Great to meet you.
Hi, welcome. And, you know, it's such an honor to meet you and to talk to the audience. Can't wait to engage in the conversation.
Fabulous. Well, tell us about Math Ventures. What is the focus of your firm? How big is the fund? What size investors do you make? Let's get to know each other.
Sure. So Math Venture Partners, we're based in Chicago. We're a $28 million Fund 1, and we're just launching our second fund as well, which will be twice the size. In our first fund, we make investments of $500,000 to $1 million. Typically, we're early-stage investors, so Series A and some seed investing. And our investment thesis is we love companies who understand how to sell. It sounds really easy, right? Most entrepreneurs are smart. Most entrepreneurs can see a problem and solve it, and most entrepreneurs fail. And our joke is, assuming the unit economics and underlying business model makes sense, nobody ever went out of business because they had too many customers. And most entrepreneurs, we go to our sweet spot, our strengths. They're in technology. They're either technology experts or maybe they're financial experts, but very few know how to sell. And therefore, we love entrepreneurs who deeply and truly understand their customers, the language that their customers speak. And I'm not talking about English or Spanish or Hindi. I'm talking about the language of how they describe their business and their needs. And most importantly, how are you going to reach them? And we look for leverage in a sales model. That's what's most important to us. We invest primarily in the United States. We are because we're based in Chicago, we have a Midwest focus. We've made 16 investments out of this fund. 6 of them have been in the Midwest, but the rest of our investments have been all around the country.
Okay. You know, we have a meeting of the minds here because our philosophy is entirely customer immersion, paid customers, and focusing on understanding the repeatable sales process. So if you look at our curriculum, we have this really evolved online curriculum at this point that has been in the market since 2010. It's chock full of selling and customer acquisition. We have this module called Sales 2.0, which is a very popular module that a lot of entrepreneurs use to, maybe you can get 1 or 2 customers, but can you actually build a business? Is there repeatability in the sales process? Can you really dissect the sales process and figure out who is the buyer, how to reach that buyer, and so forth? So absolutely, we are completely on the same page with you. So talk a little bit about industry sector as well, B2B, B2C, what types of businesses do you like to invest in? And you're welcome to talk about the portfolio of 16 that you have invested in to give us a flavor of what's interesting to you.
Sure. So my background, I've been a CEO 4 times. I've started 4 different businesses and have built and scaled several businesses across multiple industries. So we are software technology investors, but we're really interested across multiple sectors. So we like cybersecurity. We have a couple of portfolio companies in the cybersecurity world because we feel there's a great sense of urgency in that marketplace, obviously. We like fintech. So we have a couple of fintech investments. One you may have heard of called Acorns, which is doing very well. They're in LA. We have another company, a cybersecurity company called Red Seal. They're based in the Valley. We're B2B primarily, so 90% of our portfolio is B2B. We have a little bit of B2C. We like marketing tech companies. We have some education tech companies. So we have a healthcare company that's doing exceptionally well called AppRevita. And that's another interesting in terms of a sales model. So AppRevita provides a data and analytics relationship manager for the healthcare industry. So if you think like a CRM manages customers. This platform manages data and analytics. And they just announced a deal with the Joint Commission, which in America, the Joint Commission is the organization that certifies and audits every hospital in the country. And they have to go through this Joint Commission audit process or they're basically out of business because they're not eligible for Medicare reimbursement if they're not audited. And therefore, this particular company just signed a deal with the Joint Commission, which is going to provide AppRevita to every hospital in the United States that goes through the JCO, the Joint Commission audit.
Wow, congratulations, that's a great deal.
Oh, it's an awesome deal.
Awesome deal.
The company still has to execute, but that's an example of compliance or leverage in a sales model, right? And so that's what we look for.
Can you also double-click down for us into cybersecurity? Because, yes, cybersecurity has urgency. It is also, as a result, one of the most crowded markets of venture capital, and it has always been that way. I've been in this industry for more than 20 years, and there's always been huge amounts of cybersecurity investments and huge amount of cybersecurity startups. How do you parse cybersecurity?
Well, I'll give you an example of the 2 portfolio companies that we have. One is called Now Secure, and they are the experts in mobile. So a lot of threats. So if you look at utilization, there is more utilizations and transactions done through mobile than on the web. But if you look at resources, the vast majority of resources and infrastructure around cybersecurity are on the web. So if you look at a CSO, a chief security officer at a large company, and you say, show me your head count, the head count and the budget is all web-based. But if you look at the activity is on mobile. So we think there's a real disconnect between where the threat is and where the resources are being spent. And so Now Secure is one of the leaders in the industry around mobile security. We really like that a lot as a niche. Red Seal, another one of our portfolio companies, is doing exceptionally well. And they, as opposed to trying to block bad things from happening, what they do is they provide a very detailed map and analysis of every single device in a large network and how those devices and where those devices are connected. And so it's shocking, but many large organizations really truly do not have a map of each and every one of their devices and the interconnectivity between those devices. And that's what Red Seal does. We
have covered Red Seal, so I know this company. So I'm going to switch gears and double-click down a bit on understanding your stage preference. And let me preface that by saying, you know, when I was younger and raising money for my companies, we used to be in a simpler world where we had seed and we had Series A. But now we're not in that simple world anymore. The ecosystem has become very segmented. The early stage ecosystem has become very segmented. So you have friends and family, you have pre-seed, seed, post-seed, pre-Series A, and then Series A. So by the time you get to Series A, quite possibly you could have raised 5 rounds of financing already. So where in that continuum do you like to play? What is your sweet spot? And what are the metrics that anchor a company to qualify for what you are looking for in terms of stage?
So yes, it's true that nomenclature around stages are changing and evolving. And part of the reason for that is the time it takes to prove product market fit and the amount of money it takes to get to that place has shrunk considerably in the last 20 years. And so it takes far less money and it takes far less time to be able to prove. And so therefore, what we're seeing is shorter sprints, shorter fundraising sprints. From our vantage point, we're classic Series A, if you want to call it post-seed to Series A, but what we really like to see is some traction in that product market fit, that the company, the product is built, they understand pretty much who their customer is, they know how to sell, and what we're really looking for is momentum in the sales pipeline and an articulation of the sales strategy that is scalable and repeatable. So whatever, go ahead.
We had an investor last week who did a nice job of defining. I asked him what's the difference between post-seed and pre-Series A. And he did a nice job of defining it. He says post-seed is, validated business model, paying customers, lots of proof points, but not velocity. And pre-Series A is all of those plus velocity. I thought that was interesting, so let me ask you that question. Do you play, if there is validation, customers, paying customers, revenues and everything, but the velocity part is not yet figured out, or do you require velocity already figured out in the system?
That's an excellent way of differentiating. So the way I said it was momentum in the sales pipeline, which is another way of saying velocity, right?
Yes, I know, that's why I'm pressing on it.
Yeah, so at the end of the day, we like velocity. We will make investments in that post-seed where the velocity is not quite there yet. We have certainly made some investments in that space if we really like the team, if we really, there's a lot of factors that we have to believe in. But our preference and our sweet spot is we like it when there's velocity, when there is momentum in the sales pipeline, when there is provable, scalable way to generate growth, which is also another proxy for saying size and scale of the opportunity. There are a lot of wonderful companies out there that, as you had said earlier, that are just not appropriate for venture. And so so we just need to get an understanding, a deep understanding of the potential of the company, the potential of the market, and the team's ability to sell. So let me give you a concrete example. In the last 3 years, we've met with 4,200 entrepreneurs at my fund. We get pitched 4 or 5 times a day. The vast majority of entrepreneurs, when they come and pitch, they say, our product does feature, feature, feature. And I stop them about halfway through, and I say, look, like that's important, but I really don't care. I care a little bit. What I really care about is tell me from the voice of the customer, from the point of view of the customer, what problem are you solving? Why is that problem so urgent? And most importantly, how do you reach them? And how do you reach them in a repeatable, scalable way? And the vast majority of entrepreneurs can't describe that.
So you will never find a pitch from us that fits the first category that you described, because we harp on this exact point, is that no one cares what your product does. People care what problem you solve and how you solve it and what ROI you deliver by solving that problem.
Yes, of course.
So, you know, the other comment I wanted to make on your point about velocity is really the difference between a venture fundable company or a company that can fit the venture model and the company that needs to be built bootstrapped is the velocity.
Yeah, and I would agree with that completely. And I would also argue, you know, in venture capital, we talk a lot about the jockey or the horse, how important the team is. And I'm definitely on the side that I will always opt for the great CEO. The CEO makes, you know, a great team will take a good opportunity and turn it into a great opportunity. But the flip isn't always good. That, you know, that's not going to happen. And so a team is also an incredibly important element in this decision-making matrix.
Yes. Having said that, the market is incredibly important. I have worked with great CEOs who have chosen kind of dud markets to work on.
Sure,
and
of course.
You can't inject velocity into a dud market, however good a CEO you are.
That is absolutely true. So it's a complicated matrix. But, you know,
complicated matrix.
But we also look for leverage, too. So I use the word urgency. I think why is this problem so important that they're going to trust you, a startup, with this, you know, with this major critical issue? And so we're always looking for leverage. So whether it's an insurance company that says we're going to raise your rates if you don't use this, or we're going to lower your rates if you do use it, or it's like that Aprovita example where the Joint Commission says, in order to fulfill your audit obligations, you must use this, right? Those types of opportunities where there is some kind of leverage, there's some kind of financial, whether it's compliance or it's financial leverage, in some way, we like those types of opportunities too.
Yeah. So what trends are you seeing in your deal flow? So far you've described highlights from your portfolio that you invested in. Of course, there's a continuous stream of companies that are coming to pitch to you. What are some of the trends that are showing up in the current deal flow?
You know, it's the typical we see from all over the spectrum. So we see a lot of big data and analytics. We see IoT. We're seeing a lot of fintech. We see more B2B than we see B2C. In fact, I think the B2C deal flow is sort of diminished a little bit. And that could be in part because we're not B2C people. You know, that's not, we do a little bit. I see a lot in security. And
so the regular categories, but you haven't seen anything that stands out as a trend. I keep asking people that, are you seeing anything that is popping? Like I remember, you know, some years ago, everybody I talked to who are really keyed into this business in Silicon Valley, everybody I asked the question to was bringing up Twitter. Like there's this phenomenon going on called Twitter, and they're growing like crazy. And I'm like, is there anything like that bubbling in the system? But it doesn't seem like it right now.
I don't see any game-changing platform. You know, and that happens once every 10 years, you know, whether it was a switch to cellular or a switch to web or switch to mobile. You know, there's nothing, and they don't happen, or social media, right? These things happen, but they don't happen every year. You know, this is like a once-a-decade kind of fundamental switch. And there's nothing that I'm seeing at the moment that sort of...
So the social media trends we started observing in the 2003-2004 timeframe. In 2007, of course, smartphones, when iPhone came about. And then I would say the big data trend really picked up in the late 2000s as well, and it really, you know, zeroed in on AI in just about a couple of years ago, and there's a lot of machine learning and AI. That pretty much summarizes, and of course the cybersecurity threat, as I said, is running all the way through continuously and continues to run, will continue to run, because I think especially with IoT, the vulnerabilities have magnified. So I think there is no escape from lots of cybersecurity threats.
Yeah, we're also seeing a lot in blockchain. So, you know, there's an awful lot of conversation right now in all the various aspects of blockchain, and we're working hard to get our arms around that as well.
Yeah. So, some, you know, trend questions. How do you process the current investment climate where capital is moving further and further upstream? Yourselves, you want to see velocity already in the company. So how does a seed investor or a pre-seed investor or an entrepreneur for that matter mitigate the Series A gap? There are a lot of companies that get pre-seed, seed, maybe even post-seed financing, but don't really hit that velocity stride. And what is the destiny of these companies? How should they go about navigating their ways?
Look, most companies fail for a reason. There are a lot of entrepreneurs out there. There are a lot of companies that are not sustainable. And I'd hate to be, so I've started 4 companies from scratch. I know one of them failed. I know how difficult it is personally, deeply, profoundly. But the answer is not every one of them is going to succeed, nor should they. And it is a really tough, hard market.
There is a slightly nuanced perspective that I have on this question, you know, that I would like to share with you and then get your point. Some of these companies would succeed as a bootstrap company, but fail because they go after financing. Agree?
Totally agree. I tell entrepreneurs this all the time. The very best place to raise money is from your customers. Because, of course, right? Yeah.
We have a very nerdy equation. Entrepreneurship equals customers, revenues, and profits. Financing and exit are optional.
Right. So in my 4 businesses, 3 out of 4 of the businesses I started from scratch, 3 of them, I was able to start the business without raising any money because I got it self-funded by customers.
Okay. Perfect.
Right? So, you know, that's the answer. And I'll tell you something else. We are at the top of a 10-year cycle right now in terms of our economy, in terms of access to capital. There's more capital sloshing around, certainly in the United States, for early stage. There will be a market correction. I don't know when. I don't know how bad it will be, but our market's at our all-time highs, and we know that what goes up eventually comes down. And when that market correction happens, cash is going to tighten up. So those companies that are dependent upon the next round of funding, in today's market where cash is relatively abundant, and what happens, you know, whenever that correction takes place, whether it's next year or the year after or whenever it happens, but when that happens and cash becomes much harder, you know, I've lived through, I don't look it, but I'm just about to turn 60. I lived through 87. I lived through 93. I lived through the dot-com crash, and certainly the 08, 09. I've lived through bad markets when markets turn and cash tightens up. And so one of the things I would tell all entrepreneurs is if you are completely and totally dependent upon the next round of funding, you should be really thoughtful about that.
Well, and I think the truth is most Series A investors are looking for what you're looking for, which is velocity. And if you haven't been able to achieve velocity, velocity is achieved by selling to customers, not by chasing investors. So if you can achieve velocity, then the investors are chasing you because it's not so easy to find companies that hit their stride velocity-wise.
Absolutely.
So next question, which is also a trend question, how do you parse unicorn mania? As a seed investor or as an early stage investor, you could get buried under late-stage liquidation preferences. Even as a Series A investor, if a company is really doing well and becomes a hot company and then gets absolutely flushed with funding later on, and we are seeing ridiculous amounts of money being raised by private companies these days, 100 million, 250 million. How do you protect yourself?
That is an excellent question, and we worry about that a lot. So part of our investment thesis as a relatively small fund is we look for companies that are capital efficient. We have a couple of companies in our portfolio that have raised larger amounts of money, but we worry about that. We worry about the more and more money that's raised and the preferences that sit on top of us. And as a small early stage investor, how do we protect ourselves? And therefore, part of our investment thesis is those companies that are capital intensive, that require tens of millions or hundreds of millions of dollars of money. Those are companies that we tend to stay away from for that very reason.
Is it a fair statement? I'm reflecting on what you said in answer to my question, this question, as well as your trend guidance on blockchain. Blockchain is expensive stuff to build, right? How do you mitigate the need for doing things in a capital efficient manner, which we completely agree with, and doing blockchain deals?
So we haven't done one. So the answer
Do you agree that blockchain is capital intensive?
Well, these ICOs, I mean, we are conservative Midwest VCs, and I like to build real businesses with real revenue, with real customers, and it's early days for blockchain. And so for us, we're paying very close attention. We're reading and studying and talking to entrepreneurs and getting as educated as we possibly can, but so far we're on the sidelines, and I'm concerned about it. But that said, there seem to need to be some applications of blockchain that make a lot of sense. So take music licensing, for example, where the power of monetizing the music, went from the artist to the label, back to the streaming company platforms, and blockchain is a possibility to the technology that would actually empower the musician to take better control and understand and follow through to completion the utilization of their end product and be able to monetize it. I think there's possibilities in blockchain and through various industries that we haven't even scratched the surface on, but it's really early days.
Yeah, and we have, our main philosophy is more aligned to what you are describing as yours, is capital efficient, customers first, and none of those principles apply to blockchain. We have entrepreneurs in the program who want to do blockchain, and they need to raise $65 million in one of these exchanges, and I'm thinking, how the hell do you do that? It's not easy to do, and your survival depends on something that is so out of your control, and the probability of success is so low. I'm a computer scientist. I think mathematically, and I'm like, if I can't enhance the probability of your success, it makes me feel very queasy.
Right, of course, right. And so that actually brings up 2 points. So one, we think that money's just money. We know that it's, and we're very respectful that it's hard for most entrepreneurs to raise capital, but it's just money. So we think our leverage, we're operators. You know, the last business I built was, I was part of the executive team at Redbox, where I was heading up innovation, and we built it to $2.4 billion in revenue in 5 years. Mm-hmm. Like, I know how to grow and scale businesses. And so we are deeply, deeply involved with our portfolio company. So it's not just our money, it's our time, and that's part of the leverage that we have.
Yeah. So last question, and then we're going to switch to the mentoring portion. You know, one of my observations is that we're in 2017. Lots of stuff have been built already. And this, I'm talking more in the B2B sphere. Nowadays, there aren't so many wide open opportunities out there, but there are many, many niche opportunities, and some of these are high velocity niche opportunities. Some of these businesses need to be built for very small amounts of capital, 1 to 2 million, sold for 10 to 15 million, or maybe even, you know, 250, 500K sold for 5 to 10 million. And the assumption there is that you get to a certain amount of proof points that there is appetite in the market for something that you have identified as an opportunity, but then you really go to market with that solution through somebody else's channel, so a strategic buys you. Do you have appetite for these types of investments?
Probably not. So they're great investments, they're just not venture appropriate investments. You know, the typical venture model is you make 10 investments, 1 hits it out of the park, a couple do okay, and 7 fail. 7 return less than 100% of the capital invested in them all the way to 0. That's the classic venture model. Our model is a little bit different because we focus on sales and customers, we apply our operating skills and leverage, and we think we're going to have a much higher success ratio. But part of our investment thesis is that we look for companies that have the potential of much larger returns. And so these smaller companies are great companies. I would love nothing, you know, it would be wonderful to have a smaller company that has a $10 million exit with minimal investment into it. And if I was the entrepreneur, I would be grinning ear to ear. But that's just not appropriate for our investment thesis. That's not how venture capital works.
Yeah, that was my question. We are talking to investors who don't want to do this, and there are investors who are actually specializing in that. And part of the observation from them is that, you know, the smaller TAM, maybe there is velocity, but the TAM is smaller. This is a category that is open. And if, let's say, there is a $100 million, $150 million, $200 million TAM, that is actually a decent market for a large company to acquire a piece of, you know, software and sell it using their channel and just beef up a product line. That's the thesis, and people are, you know, making good bets there. So just wanted to get your feel for that. Okay, well, great conversation, Mark. Really great conversation.
Thanks, I appreciate it. Right back at you.
So we are going to switch, folks, to the entrepreneur pitch session next. Let me set some expectations. This is a working session now. So far, you listened to some experienced people discussing their business. Now we're going to have you pitch, and we're going to work on your business together. Now, if you disagree with the feedback you get from us, that's okay. It's your venture. You will do whatever you want to do. At the end of the day, it's your strategy. You're going to navigate it. Just listen to the feedback you get, though, because we have seen a lot, and we have done a lot, and it's based on experience that you're getting the feedback. So do yourselves the benefit of listening and processing the feedback you get. The other thing that you need to keep in mind, and I hope you've already picked up this lesson through the previous bit of the conversation, not all businesses can raise money. Not all businesses should raise money. and raising money doesn't guarantee success. We're going to go to Epi Ludvik Nekaj, who operates out of Singapore and Berlin, but is now pitching from the Bay Area. Welcome, Epi. Please unmute your line and tell us what you're working on.
Hi, Shimana. Thank you for having me. I'm really excited to be here, and I really liked Mark's comments. I think what's very important.
I did too.
What's very important for the entrepreneurs is that they must understand the two most important departments in their venture, and that's like sales, and the second is like sales support. So you get those two right, everything else will come to flow, and you'll learn a lot from customers than you can learn from any people who say, I like your product, without.
That is correct.
Can you hear me?
Yes, so tell us, what are you doing, GoGo Places? And where is this photo taken?
So this started pretty much by accident in a way. It's based out of Berlin. Now it's a late stage MVP. And basically, it started because a friend of mine from Boston, a good friend of mine, we've done a couple of ventures together. He's an architect with a background, and he always loved Croatia, so he ended up moving there, buy a house, and bought a sailing boat. But then he wanted to develop his hotel there. And then, long story short, I was there in Rome and ended up seeing him there, and then looking at his venture. But basically, what we found that there's a market that pretty much there's a lot of these summer homes that are available. They're sitting idle in these off-season places. And so that's where the whole story started. So I'd like to go to the next slide and just explain to you like what we have in mind here. So we really want to really create this digital real estate. So taking this real estate that is pretty much like sitting idle and making it digital, bring it online and create a marketplace, and also introduce, just like what co-working spaces or the WeWorks have introduced, the flexible offices. We like to introduce the flexible living way. And the way how we're doing is like, if you go to the next slide, is that we have found that there is this a market that is on a rise, and they're called digital nomads. So when I started learning about digital nomads, I thought this digital nomads, these are like some restless student who just wants to go see the world like 5 days in each country. But actually, there is a digital nomads out there who are really professionals who do this for years and years on.
We have great case studies of entrepreneurs who are digital nomads, and they're doing very well. They love just living in different countries, and
Exactly. And so after doing some data, crunching some data, we found there's some really interesting stuff. So for example, if you look at from the supply side, we just put some of the countries there. You can see like how many of these countries are off season. Like for example, Croatia, it's 9 months off season. You have Greece, which is 7 months off season, and the list goes on. And so think about all these homes that are available that we can tap them in. And my background comes from crowdsourcing, so I always think in terms of what can we do with crowdsourcing, how we can apply the crowdsourcing methodology around new businesses. So when we started crunching this data, we also found there's also a big problem, and the problem is that average homeowner spends 39 nights a year in their summer home. So you can imagine, like, that is pretty much a big burden for a lot of homeowners, like having a home pretty much like sitting there idle. So when we started looking into the old markets, we saw that, oh my God, this could be a really much bigger than initially we were thinking. So if you can move to the next slides, we put like a different marketplace like Americas, and if you can move to the next slide again. We looked at, so that's Asia as well, and if you can move to the next slide. Yes, so we look at it, we say, okay, well, this is a big space, but wait a minute, there is AirBnB there. There's all these guys who are really addressing probably a similar market, but then we find out that these guys are addressing a similar market, but on a specific area. And so, for example, AirBnB, for example, 90% of their revenue comes from urban places like Paris, New York, London, San Francisco, you name it. So that they're more focused in terms of like the short stay, eating pretty much like a hotel's lunch, and that's why they have lots of cities or lobbies that are going against them, because they really see that as a really big threat. And then you take a look at HomeAway, and all these guys are looking at very short term. And so when we were looking, like we say, like, okay, what are the markets that are addressing something else? And these markets are something like what they're doing is they're saying, hey, digital nomads, or hey, you people, if you're working remotely, there's no reason why you should sign up a lease for 1 year in one place, because you're always moving around. So why don't you sign up a lease with us for 1 year, and we move you around? And so we found there's some companies there, like a Remote Year, a Roam, and there's a Workaway, and we thought that we are in that group. The reason why we picked that is because when I look at, for example, a Remote Year and Roam, they are really introducing a new flexible living. However,
this is excellent positioning. I like it very much. And I'm very aware of what's happening in this market. So positioning-wise, you've done a great job.
Thank you. Yeah, well, I think my marketing background really works very well. So when I look at, for example, like the solving problems, because I like to go straight into solving problems, you know, but solving problems, you got to match it with who's buying it, you know, because a lot of people, they like your stuff, but if they don't buy it if they don't like it with a wallet, you ain't going anywhere. And the worst thing that you can ask is, like, you can ask your friends, how do you like my product? Because your friends, they're probably going to buy it one time and that's it, just because they don't want to hurt your feelings. But if you,
they're being nice. You don't want people who are being nice. No, you want people who really want your solution.
I always say, like, your friends should be your last customers. That's my focus. And so we look at, like, what problem we're solving. So we're solving the problem for the homeowners, so they can make some extra income. But then also we're solving this really problem in terms of the demand side for the digital nomads, which is pretty much like you know, making their life easier. And I cannot tell you how many of these guys that we have booked in our place that they would say, oh my God, this is so great. This is like a concierge service for digital nomads. And so
just as I'm looking at your demand side, there's one thing you may want to add is specific features. Like if I were doing this, for example, I'm just thinking through this in my head. If I was doing this, I would probably have some specific features that I want in the places that I want to choose where you have inventory. So, you know, that would be something that you want to build into the program.
And you mean specific places in which term?
The specific type, like, you know, a place that has a lot of culture, for instance. Or a place where you can listen to a lot of live classical music, or you can dance a lot of tango, something, I mean, whatever is the passion of the person that who's looking for this.
As a matter of fact, Sharmana, one of the things that what we are really looking to in a positioning side is that we're not just going to be this application where you are finding your next home for 1 month or 2 months or 3 months, because the minimum is like only 1 month. But what we are going to really end up finding is that you're going to discover places otherwise you've never gone and visit before. And so what we're doing, we're only going in the off-season places, in the places that you will probably not go there or you've never been there. And so in our model is pretty much not being in a big urban places or the big cities. And I think that's what we want to really introduce. So as a discovery app, and not just like a home.
Yeah, but you know, the feature function is important, because I don't want to go someplace and be bored. And there are, for example, if you look at, in fact, in the countryside of France and Italy and small places, there is a ton of you know, beautiful places with beautiful properties where you also get a lot of culture, and those would be probably more the kind of places I would like to go to.
That's a really good way. So you know, and why now? You know, obviously, you know, there are data out there that by 2050, you're going to have 70% of the population living in urban areas. But then by 2050, you're also going to have a lot of people who pretty much like are not working, but they're gigging in a way. They're transferring knowledge. They're not really working in physical context anymore. So there's a couple ways that I think that, you know, this is really heading to. And if you move to the next slide. And basically what our model is like, we're not really reinventing our business model. We pretty much like, we just look at the copy and paste of what Airbnb business model is. And we said, okay, this is how we're going to go from day one. So we introduced this 3% fixed the rate that, you know, from a supply side. So the homeowners, they get charged 3%. They don't get paid. They don't get paid until the tenant shows up there and there's no problem. So money sits in escrow. From a demand side, we charge anywhere from 7 to 13%. So if you move to the next slide. And in our case, our current traction, as I said, like I like always to go straight to the sale. So we have over 150 plus homes that is listed, 100 plus customers. Some of them are paid, some of them are not paid. We waive the fees for them, but also we introduce some kind of like a credits to them. So we take those credits on our own as a part of the enticing people to be going to buy it. And right now, what we are really at the moment is that we are at the late stage MVP. And what we're doing is something different, is like we're introducing another A/B testing for the version 2 of late stage MVP and see how that's really going to take off between what we have now, what we have later. And once we have that really good thinking, then we have a good opportunity to go and build a full architecture for us.
So can you explain this business model a little bit more in that you said you're thinking that you are going to, you know, rotate a digital nomad throughout your properties, across multiple properties for a whole year or multiple years. Have you started seeing that kind of commitment from your community?
Yeah, I mean, we started seeing like if people coming to us and say, oh, I see you're also in Croatia. I see you're also in Montenegro, for example. I'm going next to the Montenegro. Can you help me finding another home from your listings right now? I don't see any of the properties that are they're good for me. But if you can find something for me, that's great. So we find this. We see that. But I think this could be a really good.
What do you think, given those assumptions, what is your expected customer lifetime value? How much revenue are you going to make from one customer?
Yeah, I think we're in a very early stage to figure that out for now. But I think there is some really that the product has a good shelf line in terms of like taking the customer to the next journey. And I can pretty much go and base this based on, for example, remote year. Remote year does, for example, like 1 year you sign a lease for them. I think it's $2,000 per month that you have to pay. But you go 1 year, and what they do, they take you 1 month in each different country. The problem with that, that they are more like in a logistics business. I don't want to be in logistics business, you know, because they have to group all these people, all that stuff. So it's a bit too early to tell for us, but I can totally see that, you know, as the work is shifting, being more virtual, I can totally see that there's a really big opportunity. So I can't really give you a definite answer, but definitely there is a more than 1 year.
So that's the question you will get from, if you choose to go after investors, that's the question you would get from people. That's what is the business we're talking about here? What business are we building?
Yeah. So
okay.
I'm quite sure there's more than 1 year that we'll take a person in journey, but you know, let's see. So here's our core team. The guy to the right, Dren, is a good friend of mine. We've done a couple of ventures together. He's from Boston. Now he moved to Croatia, bought a house, living there. And then Alan, he's a full stack developer. we don't have titles in this new venture, and we decided we're never going to have titles until we really get big, and then we can figure out, because I think title kills cultures. And this is what we're doing as the next hire after we do the version 2 of our Do
you have questions?
I'm sorry?
Do you have questions?
Yeah, I mean, the question for me would be like, what is it that you see here that as an investor you would like to see from the stage that we are in right now with 100+ customers and look into the version 2? Is this the right way to really take this? Because I myself, I haven't raised a lot of money before, and I'm just really looking at it like, what's the angle here?
You have to quantify what is the business we are building in terms of business model and in terms of, you know, exactly the kinds of questions that I asked you. And there's a series of other questions I would ask you if I were looking at this as an investor, just to try to understand the business. So if there is, you know, both on the supply side on the and on the demand side, you know, how many, what is the strategy of how you acquire properties? What is the strategy of how you acquire customers? And how do you, you know, move people around? What are the digital nomads looking for? Are they trying to live in different countries of Eastern Europe, or are they trying to live in different continents in the course of a year? And that will drive what type of you know, property acquisition strategy that you need to put in place. And then comes the question of how long does a customer stick around? On the demand side, how long does a customer? On the supply side, it's simple. You know, expectedly, if you you know, acquire a property and you deliver the service that you're saying you deliver, people stay with you. But on the demand side, you need to understand, you know, how long people are willing to do this. Do they do it for a year and then settle down? Do they keep doing it for many years? What is the lifetime value of that customer? And that gives you an idea about how much can you spend on customer acquisition. What is your main customer acquisition strategy? So that correlation between high velocity customer acquisition and good solid monetization, profitable unit economics and so forth, that is something I would need to understand. But and then we would need to understand TAM. Based on those assumptions, you need to create a TAM model. Is how big a market are you able to go after now, and how big a market do you expect it to be in, you know, 5 years, in 10 years? So all of those need to be part of your pitch.
Yeah, very good points. Thank you.
All right, well, good presentation, Epi. I like what you're doing, and
thanks, Samana.
You're welcome.
Yeah, thanks for having me here. Yeah.
You're very welcome. Emmanuel Udeagha, you're up next from Lagos, Nigeria.
Hello, are you there? Can you hear me?
Yes, we can hear you. Please go ahead.
All right. Okay, my name is Emmanuel Udeagha from Lagos, Nigeria. I'm the CEO of Pukena Concierge Services. I was just 3 months old. We just launched July 2017. So next slide, please.
You need to speak up a little bit. Some of what you're saying is getting kind of lost.
Okay, can you now?
It's better, yeah?
Okay. Okay, so our target market for Pukena, they include high-end Nigerian families. We discovered that there is a pain point when it comes to service delivery in Nigeria. Most service providers in Nigeria are not trustworthy. There are cases of abandoned projects. So many government projects live around now, and who collect money and disappear. Okay, I'm sure you know what I'm talking about. So we saw that as a very big problem. So we decided to solve it. We want to restore integrity back to the service delivery industry in Nigeria. So that's why we want to set up this project. So we want a platform where our clients can confidently hire service providers such as carpenters, plumbers, okay, without fear that their money will go down the drain. So that's the essence. For market segmentation, okay, we are targeting high-end families with average monthly income of 300,000 naira. Okay, that can afford servers. We are also looking at corporate executives who spend an average of 10 hours at work. They don't have time to do certain things for themselves. So we are also working towards serving them. We are looking at government agencies. There's high rate of corruption in our government.
Yeah.
A lot of people hire contractors and nothing is done. So, but we want to make sure that any service provider hired on our platform has been certified, has been verified, and there is a system to make sure that it delivers. They are targeting celebrities and high net worth individuals that love parties and events. Next slide. Okay, so our value proposition. We have a user-friendly online and mobile app where our target market can hire separated service providers they can trust. Then we have a 6-week intensive for our registered service providers. This is geared towards helping them to raise their standard of service delivery. Okay, and we have a very strict rating system where there is a zero tolerance for unprofessionalism. If there's complaints from clients concerning any service provider, we take some drastic measures to make sure that we correct that. So we want to ensure that only the best and verified service providers are hired through our platform. Our customer acquisition strategies, we are making use of different strategies. This is a business that I started from scratch with my little savings. So far, we've not raised any money for marketing. So we are using every medium of free marketing strategies, content marketing through our blogs, influencer referral programs. Okay, we are using some religious organizations, some sub-celebrities who can talk to their followers about us. Then we have a free cleaning services program, where we go house to house to offer cleaning services for free. And by then, a lot of neighbors around them, we take note of our services and then we can cross-sell. Then we have email marketing, social media marketing, free seminars. Next slide, please. All right, so far we have listed about 150 separated service providers within Lagos. Okay, and out of that number, we have about half of them built to take part in the pilot 6-week intensive built for January 2018. We've cleaned 10 homes for free so far. 5 paying clients averaging about 300,000 in revenue. Then over 2,000 unique visits of the website. Like I said, we are purely bootstrapping. So most of these results are just a direct result of our bootstrapping. We have not actually increased our market.
Emmanuel, this 150 service providers, are they all cleaning services or is it a more diverse population of services?
Yeah, no. We have about 9 categories of services on our platform. We have event services, we have home maintenance services, we have beauty services, we have tutorial services, we have digital services, vehicle services, and so several other services. So it's not just cleaning services. So if you want a web developer or software, a home tutor, but we design the service such a way that it's home service based. Okay, so
yeah, I understand. We have stuff like this obviously in the US as well. So 5 paying clients in what category? What services have you seen people pay for?
Yes, majorly for now, the categories people are paying for falls under home maintenance and digital services. Okay. And a few from vehicle services. We have sent some mechanics, some auto mechanics to fix cars. Then we have cleaned houses, and then we have developed a website for a top client.
And this 300,000 naira, is that a gross revenue or net revenue? So this is what you are charging as the top line, and then a large percentage of this is going to the service provider, and you are keeping a small percentage of commission on this, correct? That's your business model.
Yes, we have a service charge that we charge the client, okay, and then we have a commission we collect for each transaction. So the 300,000.
What is the? So do you have a slide on business model?
I actually followed the points that we were giving.
Okay, that's fine. That's fine. So I think I will answer your questions in a moment. You know, as part of an investor pitch, you're going to need to do a slide on business model where you should call out what is gross and what is net from a revenue point of view. Because if you say 300,000 naira is your revenue, that's a bit misleading, because you probably 10% of the 300,000 naira is actually your revenue, because that's the commission you're collecting. And if there is another source of revenue of some kind of a service charge or listing fee or something, you need to list that out separately.
Okay.
Okay, so let's go to your questions. When do you go for a seed round? Well, what you heard earlier in the presentation, in my conversation with Mark, is very typical, you know, of what's happening in the industry. And in geographies like yours, where the early stage ecosystem is a lot less developed, there is a lot less money and there's a lot less appetite for risk. So the more you can mitigate risk and show proof points, the better you are, and part of that proof point is showing velocity. So the more mature an ecosystem, the more money there is in that ecosystem, the more people are willing to take risks. So maybe they will be willing to do something where you have got proof points in terms of customer traction, but not quite velocity yet. Those are risks that people in mature markets may be willing to take. In the immature markets, people don't take those risks. So they will want to see everything in place. So I think you're going to have to continue bootstrapping for a while and get a lot further with revenues. So ideally, you have to keep your burn rate very, very low. So if you can manage to do this within, you know, a couple or 3 people, and you know, get to a certain amount of traction and understanding of your business and so forth, that needs to be, you know, part of your strategy at the moment, because I don't see a seed round coming in anytime soon. It will take a little while for you to prove all the different points that will get you ready for a seed round. And then the next question on equity is, you're asking 50, 30, 20 for yourself, your co-founder, and your CTO. If the CTO is not full-time and the co-founder is not full-time, you're being very generous with a 30% and 20% equity. If they're full-time, then it's okay. But if they are part-time, then and if you're the only person who is really full-time, then you should give yourself more equity and cut back on the amount of equity that you give to the others. That's kind of the standard. We can get into more details if you like, but that's, you know, like broadly 30,000 foot, that's my guidance to you. The other question that I would look for if I were thinking of investing in this company is, how do we calculate TAM? So you showed a customer segmentation slide of high-end families with average monthly income of 300,000 nairas and above. How many such families are there in Nigeria? Corporate executives who spend an average Is that a superset, subset? You know, all these different segments that you're talking about, you need to quantify them by way of bottom-up TAM analysis. And if you don't know how to do bottom-up TAM analysis, just hang on. I will go over how to use the 1M1M resources to plug your methodology gaps, okay? So did I answer all your questions, Emmanuel? All right, we are going to move on, and I'm going to explain to you a bit of how to use 1M1M, and then we can do as much open Q&A as you like until 9:30 a.m. Pacific time. So we have about 25 minutes left. I need about 5 minutes to explain to you how to use 1M1M, and then we can go into Q&A for as long as you like. Before we do that, I would like to request you to, if you like what we are doing here, to request serious entrepreneurs to come into 1M1M. And the word serious, if you notice, is in bold. Why? Because, you know, if you are an entrepreneur whose sole agenda is to raise money and you're not willing to put in the heavy lifting required to actually acquire customers and figure out your sales process, all of which are very cumbersome, time-consuming, heavy lifting processes. If you're not willing to put in that kind of heavy lifting, this program is probably not for you because you won't be able to get what you can or what you should out of it. So here are the resource guidelines. 1Mby1M.com is your starting point. You'll find a blog that is chock full of information, educational material, etc. The Entrepreneur Journeys book series is a good place to start. You have 12 volumes of Entrepreneur Journeys books. They're all case study based, 12 to 16 case studies each. And you can double click on a particular topic, whether it is positioning or whether it is women entrepreneurs or bootstrapping using services or bootstrapping with a paycheck or billion-dollar unicorns or e-commerce or cloud computing. You will find tons of material in these books, and it's a good starting point. It pretty much follows our methodology and shows you how people have done it, how people have put one foot before the other in each of those categories. So it's very helpful to get started with your learning process. These roundtables, these free mentoring roundtables happen every week. You can come back week after week after week, listen to the recordings as much as you want, all that is available. The full acceleration program from 1 million by 1 million is 1M1M Premium, and that covers extensive methodology development guidance, full curriculum, online curriculum. We help you with business development. We help you with strategy consulting on your project. That's a project-based consulting or mentoring, coaching, whatever you call it. We also help you with financing. We have a very extensive network of investors that we work with that fit in different segments of the early stage ecosystem. And we have a lot of clout in the media. We help you get your word out there. So that is $1,000 annual membership fee. Feel free to sign up and we'll be happy to work with you on your business. The 1M1M self-assessment is a free questionnaire that you should put your business through. These are the kinds of questions investors would ask you. So it's good that you ask these questions of yourselves and really get, you know, in the mode of answering core strategic questions. 1M1M Basic is our monthly curriculum-only option, which is designed to plug your methodology gaps. So as you're going through the self-assessment, if you come into questions that you don't understand how to answer, 1M1M Basic may be a perfect option for you to go learn how to answer those questions and how to basically tackle those methodology elements. Bottom-up TAM analysis is a good example. If you don't know how to do bottom-up TAM analysis calculation, you really need to learn. It's an essential component of doing any kind of investor pitch. So dig around on the website. There's tons of information on what to expect from Premium and Basic, and there are FAQs, video FAQs. You can very easily get to know how the program works. There's lots of information on the curriculum. The curriculum is a case studies and video lectures based curriculum. We've had over 750 successful entrepreneurs, including 50 plus unicorns, 400 plus venture funded companies, 300 plus bootstrap companies participate in this, case study program, sharing their wisdom, sharing their journeys so that you can learn from them. There is nothing like this available anywhere to stand on the shoulders of so many successful entrepreneurs and learn from them. Our methodology is lean, capital efficient, bootstrap startups, and that's just the way it is. The industry works with the assumption that you're going to do your share of bootstrapping to get to the proof points and the metrics that they are looking for. So if you don't, understand and appreciate the requirement of the industry, then you're going to be spending a lot of time, wasting a lot of time, getting rejected by investors, or signing up with investors who don't know what they're doing, dumb money, and that's also another kind of liability that you don't want to impose on yourselves. That's pretty much it. We have 4 roundtables, free roundtables before Thanksgiving, and then I'm going to be traveling for a bit and we'll be back in December. We also have tonight a rendezvous, in-person rendezvous in Menlo Park at Cafe Boroni. If you're in Silicon Valley and we'd like to, whether it's visiting Silicon Valley or based in Silicon Valley, and if you'd like to come see me in person, please come by to Cafe Boroni at 8 p.m. Pacific time. And then we have 2 more of those scheduled for November 9th and December 13th. So we have had a lot of requests for coffee meetings with me, and this is our response to create a program where you can actually come and hang out with me in person. So that's it, Q&A time. Anybody has questions, you can dial in to these numbers, or you can just put in your questions in public chat, and I will pick it up from there and answer those questions. And lastly, let me introduce you to also Irina Patterson, who's going to answer your questions about the 1M1M program, Irina at 1Mby1M.com. That's pretty much it. So, questions? Anybody? You can also introduce yourselves if you like. Where are you joining from? What are you working on? What kinds of issues are you dealing with? What brings you to 1M1M? Anybody? No? If you don't have any questions, then we're going to adjourn, and we'll meet you back here next week. Same time, same place. I hope you enjoyed your session today, and we will see you soon. Bye, everybody. Thanks for coming today.